What you're seeing is the value of credit being undermined. And what is the dollar? It's just credit. But of course, not many people realize that. They will wake up to it. And I read a credible report this morning that major Chinese banks have basically run out of gold bars. So, that I think is probably where the push is going to come from. People going into gold, I think the big stuff going into gold, that I think is the next move up, and it'll lead silver with it. I mean, this is why I think that, the big banks, members of the LBMA, the active dealers on COMEX are trying to get the hell out of silver because they can see what's coming.
Central banks keen to diversify away from dollar assets and investors seeking alternatives to the Chinese property market have been key to the rise in the price of gold and silver in recent years. The People's Bank of China extended its gold buying streak through early 2026, with official holdings reaching 2,308 tons in January 2026. Alasdair Macleod warns that the current market calm is a mirage. He mentions that the flight to the dollar is a fundamental misunderstanding of credit versus real money. While the trade-weighted dollar has climbed back toward 99, Macleod believes this is the wrong place to hide. He reports that major Chinese banks are now out of physical gold bars. This shortage is the catalyst he expects will drive the next leg of the rally. However, big banks on the COMEX and LBMA are already scrambling to exit their silver shorts before the physical squeeze becomes uncontrollable. In his analysis, Macleod mentions that if Beijing attempted a massive sell-off, the U.S. Treasury would likely block the transfers. Consequently, China is quietly offloading its dollar exposure by letting debt mature without reinvesting and lending dollars to third parties instead. Regarding the widening rift in asset pricing, Alasdair Macleod highlights a massive valuation gap where commodities like copper and oil appear dirt cheap when measured against the monetary anchor of gold. He observes that while these assets might look expensive in nominal dollar terms, their real value has been suppressed to historic lows. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Alasdair Macleod's recent interview.
At the moment, there is lots of confusion in the market, I think. I'm amazed that equities haven't fallen more. They will fall more. It's as simple as that. I'm amazed that bond yields haven't risen more quickly. I mean, people get terribly excited when the 10-year Treasury note yield rises by 6 basis points or something. Oh, come on. This should be 100 basis points and then some in the short term. So that's all a bit sort of odd. I think the markets are sort of, if you like, frozen into inaction in that sense. And so these moves are not major at all yet. Of course, the other sort of, if you like, gut reaction is that when things are not looking too good, what do you do as an investor? You go into you go into safety. Where's safety? The dollar. You go and buy the dollar. So we've seen the trade weighted rise from, I think it was 96 and change up to we're currently 98, 99, something like that. Not huge, but you can see that it does reflect this Keynesian, if you like, gut reaction or macroeconomic gut reaction. I think that's a better description, which is completely wrong because what you're seeing is the value of credit being undermined. And what is the dollar? It's just credit. But of course, not many people realize that. They will wake up to it. And I read a credible report this morning that major Chinese banks have basically run out of gold bars. So, that I think is probably where the push is going to come from. People going into gold, I think the big stuff going into gold, that I think is the next move up, and it'll lead silver with it. I mean, this is why I think that the big banks, members of the LBMA, the active dealers on COMEX are trying to get the hell out of silver because they can see what's coming. When you get a government with a substantial holding like that, it then becomes very much a political issue. And I think it's not beyond the bounds of possibility that the reality is that if China tried to sell down its US treasuries in large quantities, that the US Treasury would refuse to allow the stock transfers.
Yeah.
I mean, Greenspan said as much when he was head of the Fed. But somebody asked him, in those days, China was stockpiling US treasuries because it had nothing else to do with the export earnings. I remember a journalist asking him, if China turned seller, wouldn't that be a crisis for the bond market? And he said, well, they can't sell. We won't give them permission to, if that's what they try to do. And I've always remembered that. Now, I'm not saying that this is something that would become publicly known, but clearly the Chinese are in a different situation. All they can do is that as debt matures, is not subscribe for the replacements. Now, there's quite a lot of, you mentioned, sort of Cayman Islands, London, whatever. I have no doubt that there's quite a lot of PBOC hedging activity, if you like, hedging the risk by various means. And I think that, that's something. It's still earning a lot of dollars. Let's face it, despite Trump's attempts to close off the America's trade deficit with China. And I guess that what it's doing with those is it's not so much selling them into the market, but lending them out to other people, because that's another way of getting rid of it. Well, there is an argument, if you like, that you could rotate out of gold into commodities, because the effect of the declining purchasing power of fiat currencies has been to lead to a massive underpricing of commodities. And in the article that you referred to, I put in one chart showing copper, which of course is the most important non-ferrous metal because of its quantity and its role. And it's quite interesting just how divergent the prices are. If you look in dollars, there's a huge, great bull market in copper. Look in gold, it's down at roughly, I think it was about 16 or 20% of where the long-term value should be, which tells us that copper, measured in real money, the real price of copper, if you like, is very, very suppressed. So we would expect that to correct. And so if you can see that the price of copper measured in gold could go up 3 or 4 times, and at the same time, gold is going up against the dollar. In dollars, this is going to be, a fantastic bull market, if you like, on paper anyway. So on paper, yeah. There is an argument there. But, your problem is storage. Unless you're going to take paper, and, paper markets, I think, are getting increasingly dangerous, not just silver, but all paper markets are getting dangerous. If you're going to actually take delivery, where are you going to warehouse however many thousands of tons of copper you might look at?
Not in my backyard, no.
Where are you going to put all that oil? This is the reality of it. The way to trade commodities, perhaps, is in companies, corporations, if you like, in the commodity industry. Sort of copper, I think, is a fascinating metal. It's in plentiful supply. So if you talk to people in the industry, they'd say, well, we see no reason why the copper price should rise. But what they don't understand is it's not copper rising. It's the value of the paper you price it in going down. And that's the thing, really, which people have got to understand.
Regarding the shifting geopolitical landscape and its immediate impact on the silver market, Alasdair Macleod highlights a strategic checkmate move by the Russia-China-Iran axis. He argues that China is no longer just a passive participant in the global market, but is actively constructing the plumbing for a post-dollar world. Macleod mentions the expansion of Shanghai gold exchange vaults in Hong Kong and potentially Riyadh as a gold for yuan exchange mechanism. China will eventually fix a gold to yuan rate when the dollar crisis peaks, claiming they are simply protecting their own interests rather than attacking the West. Most tellingly, Macleod mentions that open interest in silver has plummeted to its lowest level in 20 years. He predicts this is because bullion banks and market makers are trying to get the hell out of their contracts, realizing there is no physical metal left to back the paper. In early 2025, gold surge to record levels drew renewed investor attention towards silver, which crossed the $100 per ounce threshold before retracing toward the $80 range. The gold to silver ratio, a widely tracked relative valuation measure, compressed below 50 for the first time since 2012. Historically, compressions of this ratio have coincided with periods when silver begins to outperform gold, as capital rotates deeper into the precious metals complex in search of higher beta exposure. Let's jump into the interview.
The fact is that Russia and China are in partnership as hegemons, and their area, as it were, basically is Asia, Eurasia, if you like, certainly up as far as the European Union. So they have a long-term view of things, and they're not going to react to short-term events, except to protect their own interests. Now, Iran is part of their own interests, obviously, because if let's assume that Iran actually fell and the Americans took over the whole place and all the rest of it. You would then have the Americans on your doorstep, just as they were in Afghanistan. The likelihood of that, however, is zero. They don't need to intervene in this one. And not only that, but the agreement which they signed back in January was not like the NATO Article 5, attack one member of NATO and you're attacking the lot. It's not like that at all. It's a cooperation agreement, if you like. And under that cooperation agreement, underneath the radar, you'll find that the Russians and the Chinese will be sending technology. They will be maybe even delivering missiles, spare parts, and all the rest of it to ensure that the Iranian war machine continues to work. That's the way they do it. They will pursue their own interests within this tripartite agreement. That is absolutely clear. They're not about to join into a war and turn it into a mega war. China has to walk very carefully here. It doesn't want to be blamed for the demise, the collapse of the West. Because that's where we're going. We're going towards collapse, economic collapse, if you like, and political collapse as well. They don't want to be blamed for that. So they're treading very carefully. They're not out there stoking up trouble. It's actually as simple as that. And that policy is not changing. Now, having said that, they will defend their own interests. And if you go back to Trump's Liberation Day, April the 2nd last year, when Trump came up with all these, tariff boards of tariffs and all the rest of it, I think if I remember correctly, the tariffs against China were an extra 67%. What happened was, in the week after that, President Xi did a whistle-stop tour around the ASEAN nations, the Southeast Asian nations where there is a Chinese diaspora, mainly, reassured them that China was up for continue for free trade, and we've got to work together to deal with an America which is trying to stop free trade. So you had that. Now, that's obvious. That was absolutely obvious. We knew that. You didn't need to be in the meeting rooms to know what he was saying and that. But what subsequently transpired was he obviously talked about the financial end of it. And there are two aspects of this. The first was payments, trade settlements through the CIPS, which is the Chinese International Payment System, which does without the dollar. The dollar is not in the middle there. If I was to buy, I was going to say Gilder, but you don't have them anymore.
Unfortunately.
If I was to buy Gilder, out of sterling, I would first of all sell sterling, buy dollars, sell dollars, buy Gilder. That's the way in which, the system works. CIPS bypasses that completely. The dollar isn't in there, if you like, as that sort of stepping stone between currencies. And the second thing is that it moved to eventually secure the value of payments. And it did this basically, it was very much a first step. The Shanghai Gold Exchange opened vaults in Hong Kong and also in Saudi Arabia, Riyadh, I believe. Whether it's actually open in Riyadh yet or what, I honestly don't know. But it's certainly open and going in Hong Kong. And Hong Kong is also being built up again, if you like, as China's international financial center. The point about this is that with these vaults, you can deposit gold and get paid in yuan, or deposit yuan and take out gold. That's it's a gold for yuan exchange mechanism. All China needs to do at some stage is to fix the rate. And I believe they will do that at a time when the dollar is sliding and it is quite clear that there's a currency crisis in the West. It can then claim that it is just protecting its own interests. It is not deliberately destabilizing the West. This is a very, very important distinction. And to my mind, that's basically what they're doing. Now, the next stage in this is perhaps slightly more subtle. And that is when Trump came in and said, we're going to charge another, I can't remember what it was, 100% or something tariffs. This was last September. So the Chinese turned around and said, okay, we're banning all exports of rare earths, full stop. Now, what we didn't know at the time, and Trump backed down, taco, Trump always chickens out. What we didn't know at the time was that the Chinese also took a decision effectively to ban silver exports. I mean, all we know is that there's a new silver export licensing regime which came in from January the 1st, and it was going to last in 2026 and 2027. That's all we know. But it's quite clear that somewhere the Chinese took the decision that with suddenly America turning around and deciding that silver is a critical mineral, and guess what? They haven't got any. What China was not going to supply silver to the West only to find it ends up, if you like, providing a strategic silver stockpile from America. Why should they do that? And it was interesting because, this was all in the more or less the last week or so of September. By October the 9th, there was a crisis on the LBMA because there was no silver. And lease rates shot up to 40%. I think on the 10th, they had to suspend trading for something like 1.5 hours while they sorted out the mess and all the rest of it. And we've now got the situation where the silver's running out of COMEX at quite an alarming rate, certainly registered for delivery. That's running right down. I mean, it's 86 million ounces or something, which is not a lot. It's something like 17,000 contracts. But the interesting thing is that the bullion banks and market makers swaps, if you like, on COMEX are basically trying to get out of the contract. There's no speculative interest in this. I mean, the fascinating thing is this morning we see that in the last 2 days, open interest in silver has now fallen to the lowest level we've seen for 20 years. I mean, just think of that.
Global commodity markets have experienced unprecedented volatility across precious metals during the past year, with silver emerging as a standout performer amid shifting investment flows and industrial demand patterns. While gold has maintained steady appreciation, silver's amplified movement reflects its smaller market capitalization and higher sensitivity to both investment sentiment and industrial demand fluctuations. As China quietly installs the plumbing for a gold-backed trade system, are we witnessing the final days of fiat credit before the ultimate rotation into real money? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.